So are we overvalued? Well, have a look at this. Since 1870, that's the S&P composite. And it's a simple measure. It's a measure which most people don't use nowadays, so do bear it with a degree of caution. The regression to trend, so you draw a trend line and you see that the S&P tends to revolve around that, of course, for long periods above it and below it. But actually what's eye-catching at the moment is the extent to which we are above that trend and the significant size by which we're above that trend. Now, that doesn't mean we might not get a new normal and the trend lines start skewing up towards that new normal. That could happen. More likely, when you look at something like this, you think to yourself, wow, there could be a significant pullback. Yes, there could. So time to take in a degree of caution and not just simply think that the markets can only go in one direction. For us, what that means is we continue for our long-term investing, which means 12-month holdings and then reviewing, to continue our focus on the resilient kind of companies which generate cash flow, revenue growth year on year, strong valuations, which is share price to profitability, consistency of outperformance, lots of money in the bank. So when we look at their P&L, their balance sheet, their three parts which make up their accounts, we want to make sure that everything looks very strong and healthy. Why? Well, because if there's a pullback, those are the companies which should fall the least, and if the market continues rising, they should continue rising. Of course, on our trading, where we might be holding positions for anywhere between a day to a week, all of this is less of a concern because we can go long and we can go short, and that is purely based on momentum. So in that sense, the macroeconomic scenario doesn't matter for trading. Okay? Have a look at campaignforamillion.com, where I teach more of this completely for free as part of my campaign to teach 1 million people how to be more financially literate.